Live from Bloomberg's brand new Mumbai studio, this is Insight with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. Beijing takes fresh steps in response to U.S. tariffs, seeking trade talks at the WTO. The U.S. Postal Service, meanwhile, reversing its decision to hold shipments from China and Hong Kong. BofA Securities will give us their outlook for Chinese stocks as a trade war with the U.S. clouds earnings calculations. Also ahead, the Singapore Exchange CEO Michael Syn joins us exclusively to discuss their earnings beat and progress on energizing the city's equity market with fresh listings. And we also speak to the CEO of India's largest hospitality company for exclusive insight on how Modi's middle-class tax breaks may boost business. The latest now on the U.S.-China trade tensions. China is ramping up its response to President Trump's 10% tariff, filing a complaint at the WTO that calls for talks with Washington. That comes as the U.S. Postal Service reverses its earlier decision to hold shipments of parcels from China and Hong Kong. Meanwhile, some senior partners at McKinsey and Company are said to be questioning the consulting giant's presence in China. Bloomberg sources say they're arguing that the lucrative North American business can more than offset a China retreat amid geopolitical risks. Our China Chief North Asia correspondent Stephen Angle has been watching all of this. And Steve, what are we hearing on McKinsey?
Well, they're faced with a dilemma that a lot of American companies do face in China, whether you like it or not. The latest American Chamber of Commerce of China's survey of American businesses indicated that about 30% of American businesses have been at least considering or have already started perhaps moving out of China because of the increased risks. And over the next 4 years, it could be escalating, according to a number of outlooks, obviously. And so this is a Bloomberg scoop that is number 2 on the most read story on the Bloomberg terminal, that some senior McKinsey senior partners telling Bloomberg News anonymously, because it's quite a sensitive issue, that it might not necessarily be worth the risk to continue to do business in China. Now, according to the McKinsey website, they have about 1,000 employees. Yes, a year or so ago, they did reduce that by about 150, but they have exchanges or businesses, client meetings with at least 1,500 different entities in Greater China. So they do have a presence, but they're not making money in China. They are definitely in North America, where they get about half of their revenue. So these senior partners are telling Bloomberg News that the profit that they're getting and the revenue they're getting from just the North American business alone can offset the pull back or pull out even of the China operations. This is something that has been on the minds of a lot of companies, including those in the consultancy space. Bain & Company a couple of years ago, within the last year or so, saw its offices raided in China. CapVision also saw itself embroiled in an anti-espionage crackdown in China. So there has been, a crackdown on some companies in America, in China, American companies, increased scrutiny because of Xi Jinping's emphasis on national security.
Of course, all happening against a backdrop of escalating tensions between the U.S. and China in terms of trade. What's the latest on that? Because we know China's taking their grievances to the WTO.
Yes. So yesterday we had the news about China's retaliatory steps, and it didn't go as far as the across-the-board 10% tariffs that the Trump administration imposed on China because of the fentanyl issues. But it also leaves room for China to do more. Keep in mind as well, these steps that they took yesterday don't take effect until next Monday, and Donald Trump and Xi Jinping still haven't had that much ballyhooed or talked about phone call. So there is time and some room to possibly negotiate down some of these steps both sides have taken. But also China had promised, and they have fulfilled that promise. They have taken their complaint to the World Trade Organization, trying to get that body, multilateral body, to essentially mediate talks between China and the United States. In their filing, Beijing says the U.S. moves to slap China with those 10% tariffs were imposed on the basis of unfounded and false allegations. The measures at issue not only violate WTO rules, but are discriminatory and protectionist in nature. As I said, there could be some further action by Beijing if these two gentlemen, Xi and Trump, cannot have a meeting of the minds on some kind of impending phone call. China did not issue new tariffs on agricultural products as it did in 2018, 2019. Soybeans in those first 2 years of the Trump administration, version 1.0, dropped 80% because of the friction between China and the United States. It hit the U.S. farmers to the tune of $11 billion. That is action China could take. And we're also seeing as well action potentially being in the works to launch an antitrust investigation of Apple's App Store based on its fees and possible monopolistic behavior there. Alleged, of course. So that's in addition to the investigation, antitrust investigation that China has launched on Google. So there are a number of steps to escalate this, but we're still awaiting a potential phone call between those two leaders.
That's right. We have to see how that develops. Chief North Asia correspondent Stephen Angle, thank you so much for that. And of course, as we talk about China, let's do a check on how Chinese stocks are doing. Some calm seems to be returning. We're seeing gains for the benchmarks in China. CSI 300 index rising as much as 1.2%, currently up by 0.8%. Of course, that's on the back of the U.S. reversing its postal action, now accepting mail and packages from China. Also, as we heard from Steve earlier, China seeking talks with the U.S. at the WTO following the 10% tariffs imposed on China exports. In terms of the Chinese yuan, 728.22, currently lower by about 0.1% versus the USD. Now let's discuss the trade and tariff risks for Chinese markets with Matty, co-head of China Equity Research at BofA Securities. Matty, good to have you with us. I mean, we've heard the tit for tat and how the U.S. took action, reversing its action. I mean, how are you assessing how we should be viewing the Chinese market right now against that backdrop?
Thank you. I would say that if the trade tensions stay as it is, i.e. only 10% increase and only for the direct export from China, not expanding into indirect export, not expanding into higher tariff, I think the immediate impact for a lot of the sector I cover are relatively limited. So, for example, we only export 1% of our steel to U.S., around 11% of aluminum to U.S., but, out of aluminum production, only 13% is exported. So the impact to the production is also relatively small. Coming into lithium, if you look at the China auto directly export to U.S. is about 0.2%. Battery export to U.S. is around 3%. So if it's controlled and if we can have some kind of mitigation in between, I think the direct impact will be relatively limited. However, if we come into a bad scenario, i.e. the tariff expanded into like Mexico, Southeast Asia, etc., because we do have a lot of indirect export into U.S., then that would be creating a bigger issue from there. Thank you.
Matty, we know that trade is just one factor. The other is also to do with its economic lackluster performance so far. We're still waiting for the stimulus. It hasn't come. That triple R card is still not in sight. How are you assessing the attractiveness of the Chinese market if we don't see further moves by the Chinese government?
Sure. Actually, if you look at the post-Chinese New Year data, I think the consumption so far is in line with expectation. It is still led by the low-tier cities, the travel, and also some spending on the home appliance because of the new exchange program. So far, we are still waiting for more stimulus. However, if without further stimulus, I would say that I will go for a more conservative space basis. Like, say, for example, this year, our top pick at this stage will be gold. You can see that gold prices is near 2,900 already. That is because of the tensions between U.S. and China, and also the global trade war potentials. And we are also seeing global central banks buying for gold, ETF buying for gold as well. And according to our study, when you have more black swan events and more volatility in the world, and gold normally perform well as well. So we are seeing gold hitting probably $3,000 by end of this quarter or early next quarter. And some of our top picks are all in the gold spaces. Thank you.
So if you're suggesting that gold could get to 3,000 by the end of the quarter, where might gold be by the end of the year?
Yeah, that will be very depending on how the U.S. and China relationship and the global, the tensions as well. If we are seeing, a worse scenario or bad scenario in terms of these trade tensions, then maybe the gold can exceed 3,000 from there. That is why we are only setting a near-term target for the 3,000 for the end of the quarter, and a lot of them will be very depending on the next talks, probably between President Xi and President Trump.
In terms of the other materials, you're also pretty upbeat on cement. You're upgrading your call on that. Give us a sense of why that is the case.
Yeah, of course. I think the reason for upgrading cement, first of all, cement sector has been underperforming for about 5 years because of China property decline. And we are seeing that the property impact continue, but having a smaller impact given the proportion, the new starts is already down 70% compared to the peak. So the impact from property to the building materials is getting smaller. At the same time, government is quite determined in cutting cement capacity. Based on the new rule, by the end of this year, we need to cut the cement capacity back to 1.8 billion tons. So that would imply a 10 to 20% capacity cuts as well. Also, because we are also bearish on the coal prices, and we are expecting the coal prices drop, will help cement margin recovering. And the cement sector is trading between 0.2 to 0.5 times price to book, giving you about 5% yield. And lastly, cement is a pure China sector. So it will be less impacted by the U.S.-China tensions.
What will it take for coal prices to reverse, for you to be more upbeat about its outlook?
Yeah, so we actually downgraded coal sector as a whole, and coal is one of our most bearish sector this year for both thermal and coking. That is because we're doubling our imports of coal in the past 2 years from below 300 million ton to above 500 million ton now. And at the same time, China is also increasing its supply after the safety check in Shanxi and also from Xinjiang as well. And of course, the EV growth, the replacement of solar is also hurting the coal demand. So and historical high coal inventories. I think in order to become more positive, we need to see a big drawdown on the inventory. Currently, inventory is nearly 700 million ton compared to the past of average of 300 to 400. So at least we need the inventory to go back to the normal level. And then, of course, if we are seeing extreme weathers or some major disruption on the supply, say extreme weather in Australia or extreme hot weather in India, etc. Otherwise, it would be very difficult to become positive.
But the case of coal consumption is actually on the rise. In fact, when you take a look at global coal consumption, it has doubled in the last 30 years. What assumptions are you making about consumption and demand?
Yeah, of course. We are not saying, so our bearish view is not based on a decline on coal demand. We are actually still expecting about 0 to 1% growth in the overall coal demand, actually until in next 5 years. So our bearish view is more from a high inventory and also high supply growth stories. If you look at the past 5 to 10 years, actually the source of supply into China market growth, including like Australia import starting from last year, Mongolia import after the railway between China and Mongolia, and then also Indonesia has increasing more than 1.5 billion ton, 150 million ton of coal into China.
Matty, I want to take a look at the Chinese market. There's been a lot of focus on DeepSeek, and some say perhaps DeepSeek could perhaps revive China's tech sector. How are you viewing that?
Yeah, there have been lots of talks on that as well. Even on the sectors that I cover, people were saying that, because of the DeepSeeks, that probably will push up for more China use of copper, etc. And it also may, there are also some clients talking about because of that, maybe the U.S. dollar centralization will get hurt, and also pushing up for gold prices. I would say that from commodity world, so far we are not seeing big changes on the commodity supply and demand because of the DeepSeek. But of course, it's something that we need to watch for in terms of these fast-growing AI sectors.
Do you see perhaps a revival then in the tech sector or not, on the back of euphoria of a DeepSeek and AI?
Yeah, so there is also concern that probably the U.S.-China tension will not only limit on the tariff, will they also be expanding into a more tech restrictions. So that's also a concern on the overall market sentiment as well. That's why, again, out of the sector I cover, that's why we suggest investors not to go into copper in the early of this year. Probably wait for a better color into the second half first until we see more clarity into this area. Because copper, it is very highly driven by power grid and also very related on the AI sectors.
Matty, when it comes to oil, has China reached peak oil or not?
Yeah, so we don't think oil demand is peaking. We think coal will peak first, and then oil. We think that probably coal demand will peak at 27, 28, i.e. in the next 5 years, and oil probably peak in 2030. And then gas will probably can grow the demand until 2040. And gas will be at a bridge, energy as well. And we are seeing China gas demand to grow at a mid-single digit per annum until 2030 as well. And of course, now you see that China taking a retaliation on the tariff of this 10 to 15% recently. A lot of them is also on the coal, oil, and gas. We think that the impact to oil is very limited because China's contract with U.S. is a lot of them is short term, so easy can be rerouted. But for LNG might be a slightly bigger impact because majority of the contract is more long term. So China, if this tariff stay, China producer may need to seek for exemption or maybe need to reroute some of this U.S. import. Thank you.
The thing is, Matty, we know that China accounts for half of the world's oil demand, 600,000 barrels per day. How might this play out into the oil market?
China accounts for half of the coal demand and probably low teens of global oil demands. So I would say that, of course, if China using less U.S. oil and sorting maybe from probably Russia or somewhere else, then U.S. oil may sort its way to Europe and other places. So overall, as long as our demand don't change, I don't think that would have a major impact on the supply and demand situation. But of course, even this rerouting will hurt the sentiments. So if the tension continue, that will also have a temporary short-term impact on the energy demands as well.
Matty, when you take a look at China's demand for oil, steel, and all the materials that you cover, how are you assessing China's recovery in its economy? Is it showing signs that a recovery is imminent?
Unfortunately, we haven't seen some major recovery, to be honest. This year, we are expecting overall commodity demand growth to be relatively slow. So we are expecting copper and aluminum demand to grow at 2%. Last year, aluminum demand grew at 5%. We are assuming coal to be 0 to 1%, oil to be about 1 to 2%, and also gas to be about 5% as as well. And coming to the construction material like cement, steel, we are still expecting a 3 to 5% decline. The only area that we see growth will probably continue to be the power grid segment. We are still expecting high single-digit growth in the power grid segments, driven by the high investment growth. And at the same time, probably some home appliance and EV sides because of the subsidies, exchange program, etc. Thank you.
Matty, thank you so much for that. Matty Zhao from BofA Securities. Well, legendary short seller Jim Chanos says President Trump's 10% tariff against China won't make much of a difference for now, and investors need to wait to see whether the trade war escalates. Chanos spoke to us exclusively about Trump's move and China's response.
I think China probably feels it was proportional, and we don't know what discussions are going on behind the scenes. So I think, again, wait and see. But I think that 10% isn't going to do it, by the way. I mean, getting back to our early conversation about the amount of tariffs you need to raise serious revenues, you know, you would have to raise them substantially on both China and the EU, and we haven't seen that yet. So we'll have to see what exactly comes within 30 days, 60 days. Mm-hmm. Does it escalate, or does it cool off? And it was an early campaign promise that he's delivered on, and now he's moved on to something else.
But at the same time, this comes at a precarious time for China's economy. You've been warning for a long time about China's debt bubble and its broken economic model. What does the imposition of tariffs, now an additional 10%, but perhaps going even higher, mean for that long-term decline?
Yeah, it doesn't help it, that's for sure, because, I mean, China saw fewer reliance on net exports after 2010, when we first put out our warning, and that it's growing again. And part of that is due to the fact that the investment-driven model that we've been crying wolf about forever, albeit correctly, is losing its impetus to continue to grow. And the banking system is still bloated, and we've seen now problems in the residential real estate area completely trickle down into the actual developers. So they've got a model that really now is facing kind of a crossroads with what they're going to do. And the U.S. putting on major tariffs to one of their few thriving parts of the engine, the export manufacturing area, isn't going to help.
And that was Jim Chanos speaking exclusively with our colleague Scarlett Fu. And still ahead on Insight, SGX Group President Michael Syn joins us after first half profit at the Singapore Exchange beat estimates. We'll get his outlook for markets and the IPO pipeline. Keep it here with us. This is Bloomberg. Welcome back. Here are some other stories we're following. President Trump's top aides are working to tone down his proposal for a U.S. takeover of the Gaza Strip, floated during a visit from Israeli Prime Minister Benjamin Netanyahu. Secretary of State Marco Rubio says Trump wants the U.S. to play a leading role in rebuilding Gaza, but not to own it. And Defense Secretary Pete Hegseth told Fox News the U.S. is a very long way away from any military deployment in Gaza. And Treasury Secretary Scott Bessent says that when it comes to lowering borrowing costs, President Trump's focus is on bringing down 10-year yields and not Fed rate cuts. Bessent told Fox News he'll only talk about what the Fed has done, not what he thinks they should do. He adds most Americans focus on energy costs, and when it comes to inflation and growing the energy supply is the way to lower prices. And we'll hear more from Scott Bessent later on Bloomberg Television. The U.S. Treasury Secretary joins us for a live interview at the times on your screen. This is Bloomberg. Welcome back. You're watching Insight. As investors navigate President Trump's tariff plans, trade-reliant economies such as Singapore are in the spotlight. Its stock market has remained resilient, boosted by the financial heavyweight. Still, it's a market that has shrunk over time. Avril Hong is here with a closer look. And Avril, if you take a look at stock prices, it's up about 28% over the past 1 year. Ain't too shabby.
Yeah, not too bad. Resilience, as you say. And if you look at the performance today, it's slightly firmer, in line with the mood in the rest of the region. The benchmark not far from record highs. And if you pull out this chart, it'll actually show you how since the month of November, it's actually been performing slightly better than the region's benchmark. And some have touted Singapore's stock market's defensive qualities, seen as perhaps a bit more insulated from Trump's higher tariff plans. And also note how dividend yields, those are pretty attractive in Singapore. If you look at the performance of the Singapore banks in the past year, that's really going to show you where the rally is coming from. These financial heavyweights, right? They account for more than half of the benchmark's weightings, and they pretty much surged in the past year, tracking the gains in their US counterparts. And there's a lot of optimism about deregulation and how that might boost profits. You take a deeper dive, though, at the Singapore market, you'll see as well that Singapore listings, the number of them, they've just dwindled over the past couple of years. We've seen more delistings than debuts. And, you know, there's a task force underway to figure out how to reinvigorate things. And this includes in the group, Temasek, the investment firm, of course, regulators, the Singapore Exchange. Today, we also got SGX earnings up for half year, about 20+% to 340 million Sing dollars based on net income, Haas.
Well, that's right. And when it comes to IPOs, the market has trailed neighbors like Thailand as well as Malaysia. Avril, stick around as we bring our next guest. Joining us exclusively is Michael Syn, president of SGX Group, the operator of Singapore's stock exchange. Michael, good to have you with us. We talk about how Singapore's trying to revive its stock market. MES on top of that. I mean, what's the progress so far?
So we just had our earnings this morning. Thank you for teeing that up. The stock market's an incredibly important and fundamental part of the group. It accounts for a quarter of our business, 1/4 of equity derivatives, 1/4 is technology and platforms. The other quarter is commodity and currencies. So the driver of the great results, record profits, record revenues, was performance across all segments, including the stock market, where I think since COVID, we've not had as significant a new influx of interest from retail or institutions into the market. And a lot of this was accounted for by the fact that there was a record outperformance of the market, even within the ASEAN context. Part of this is because of some of the macro effects that you mentioned, part of its rotation. But some of the specific things that we did see in the past half, which might help us frame why there's an interest in this segment of what Singapore's stock market represents for Asia. We saw a huge inflow, for instance, on our ETF Connect from China, almost $1 billion, into the Southeast Asian Tech ETF. So I'm using that just to illustrate the fact that there is a significant desire to move into the markets that SGX represents and Southeast Asia represents. So with respect to the review group, which is ongoing, there was a speech given on the opening day at the start of the year by Deputy Prime Minister and Chairman of the Monetary Authority of Singapore. I think what we can say is that the issues being crystallized by the ecosystem at large, from the sell side to the buy side to the issuers, fall into the categories that you might expect. What is the supply challenge? What is the demand challenge? What are the sand in the wheels type challenge? And you must have sand in the wheels. That's regulation, that's friction, because a lot of that's to do with, you know, having the appropriate traffic lights and junctions. But all of them had issues that have been crystallized, and the task force should soon be publishing some of its recommendations. Not allowed to front run it, least of all as the president of SGX Group. But the way he's framed it is very clear. And the other thing that that DPM did frame also very clearly is that there's a significant desire for catalytic capital. The way Singapore does these things is a considered and consistent process over time where there's catalytic capital to draw more interest into it. That's how they seeded the PE and VC space over 10 years from 0 to 100 billion. So we're all looking forward to seeing how will this look when they address these three buckets of issues.
Many issues, as you say, and you're saying you can't front run some of these proposals, but what in your mind is the best approach to reinvigorating the markets amid the lack of liquidity, the low valuations?
So the first thing we did was to frame it as, what does Singapore want to do? Because the market is what we can build. We're the operator. We offer a pretty world-class infrastructure, set of regulations, set of people, set of technologies. Then the question is, what does Singapore want out of its capital market in the long term? And the capital market's not a standalone thing, right? It's a market for public permanent capital that you have to decide in the long-term strategy for the country, where does this fit relative to private capital? Where does it fit relative to offshore capital? These are the issues that this review group is addressing. I mean, there are two work tracks. One is enterprise financing, and the other one is in regulation. So the totality of these recommendations will go to the chair of the committee, and then they should still have a couple of months before I think they start publishing their findings. Right. So the market itself also has some recommendations. Yeah.
Let's talk about IPO pipeline. How is it looking? Are you optimistic 2025 will be better than previous years? And might you consider crypto listings? After all, we're seeing a great pickup in terms of institutional interest.
You know, you're going to get a very positive answer, because how could it be any not be better? Let's put it this way, than the last couple of years. It is very promising. So the staging and the qualification of the pipeline is who has actually mandated an advisor, who has actually come to the regulator, and that pipeline is very strong. I do believe that they'll hold back a little bit.
Can you put a number to it, perhaps?
I've not seen it this strong, but until it arrives, you don't know. I would say that the categories of listings that we're seeing are looking pretty healthy. It's beyond just new economy and REITs. There are some other categories. The names of these companies are some of them that we've been speaking to for some time. Market conditions are good. Index levels are strong. I think what they will do is wait a little while just to see what the first shaping and crystallization of the review group recommendations will be. So it looks good. I don't want to overpromise. When it arrives, we'll shout out loud.
Okay, beyond the new economies, can you give us a sense of what other sectors? You were alluding to some of this.
At this time of the cycle, consumer and healthcare in particular are, they're strongly receptive. The market is strongly receptive to these names. And your other question, Haslinda, was on crypto.
Yes.
If they come to market or they come for advice, I think we will speak to them seriously. Maybe 4 or 5 years ago, a handful of them did come to consult as to whether it was appropriate for them to be in the public markets. I think even today, it's not completely obvious to us that this is a category that falls into either new economy or into industry. I don't know that it's something we've thought very hard about, to be honest. When it comes to crypto, there are many things we are already doing to serve the marketplace in our core franchise, not in IPOs, right? It's through FX and technology. In our FX, we already stream crypto prices for some of the major banks in Southeast Asia. In our derivatives franchise, there will be some announcements coming up about how we make available the institutional grade infrastructure that we have, especially in consideration of the way it's getting normalized in the US. We will pay attention to what the customers are saying as to what their true needs are, right? Which is liquidity, clearing, trading, matching.
You talk about crypto derivatives, but across asset classes,
yes.
In FX especially, it's done really well because of the volatility.
Yes.
What do these tariff plans mean for Singapore?
Two-way tension in the markets is generally good for risk management venues. There are very specific examples just in the past few weeks. After the inauguration that night, we saw a record volume in our RMB contracts because the news feed just one day after inauguration was such that we had, in fact, specifically Chinese asset managers in the evening session saying we need to cross a few billion in RMB. So we saw 16 billion that night. So all of this news feed leads for the need for people to hedge risks which previously they had not hedged. This includes equity risk, currency risk, commodity risk. Right. So tariffs as a whole are less about the friction on the economy. It's more about the unexpected nature of the announcements.
Michael, we know that Boon Chye has been CEO for the past 10 years. Is a succession plan in place, and would you be interested if offered that position?
Chania asked that question this morning, and she got the standard answer. I think I would give the same answer, which Bunchai gave to Chania, which is the team's working pretty hard. They've managed to produce record results. And the rest of that question needs to go to the chairman of my board, Mr. Koh Boon Hui.
Michael, great having you with us. Michael Syn, president of SGX Group, and of course our very own Avril Hong. With some breaking news out of Japan, Nissan is seeking new partners as the Honda deal is set to collapse. Of course, disagreements over the power imbalance between the two companies, bearing in mind that they were supposed to announce a framework in late January, finalize that transaction in June, and this shares of a holding company in August 2026. That deal falling through. Well, still to come, Indian Hotels CEO Puneet Chhatwal joins us exclusively here in the Mumbai studio to talk about Indian consumer demand and the hotel operators' business outlook. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight, coming to you live from Bloomberg's new studio here in Mumbai. We're counting down to the India market open, taking a look at where it is trading at the start of the trading day, pretty much in line with the rest of the region, in positive territory. Sensex up 0.3%. The Nifty also in the money. Of course, we have India has been under pressure. We know the index has dropped below that 50-day moving average. We know as well that foreign funds have been pulling money out, and it is the domestic retail investors who've been propping up the economy. Again, the Sensex up 0.3%. Now, a closer look at earnings in India. With most companies in the MSCI index benchmark already reporting results for the current season, a majority have fallen short of expectations. Let's discuss this with Bloomberg's conglomerates reporter, PR Sanjay. So disappointing.
It's not actually. In the case of Indian hotels, they have a fabulous number, and in all parameters, it has excelled. And when we spoke to analysts, and Street was very happy about the kind of a utilization rate. And in the wake of budget, they are expecting more rollout, and they are also expecting that more rollout and more launches and new product launches and portfolio coming into the phase. And I think we'll hear from Indian Hotels chief as well on the stuff. But I have a different question towards Indian Hotels, which will come. And I want to know about the capex and capex rollout, etc. And what are the kind of numbers of the inventory they would be adding in coming quarters and in next 5 years. Not just Indian Hotels always have got a 5-year plan. So I want a 5-year plan for Indian Hotels as well.
All right, we'll get to that question, Sanjay. Don't you worry. Stick around. Let's bring in our guest. Joining us now here in the studio, Puneet Chhatwal, MD and CEO of Indian Hotels, which is the country's largest hospitality firm. Puneet, good to have you with us.
Thank you for having me.
So, upbeat for the coming quarters for the business?
I'm always by nature upbeat, but as Sanjay just mentioned, the numbers have helped support that opinion of mine. And I think demand is going to keep outpacing supply. And as long as demand is outpacing
what kind of growth
supply,
and demand are you anticipating?
We think anything close to 7-8% growth in demand versus a 2 to 3% increase in supply. And the supply is coming in the newer destinations, Tier 2, Tier 3 cities, where under the government Udan scheme, the new airports are coming in. It's not really so much, in the top 10 hospitality markets of India. There it is pretty constrained, and that's helping with the rates and with the occupancies.
How much of a boost do you think the budget will provide? It is, after all, focused on consumption. I know it may take quarters, but what trickle-down effect do you see?
See, first of all, we have to understand that hospitality and tourism is moving from discretionary to also a consumption sector. And any boost, any incentive for consumption should help get us our fair share from that boost. And I am really optimistic that a lot more people will travel. And we should not forget, this is the year of the pay commission. So there will be a double, kind of impact on low taxes and increase in salaries. And that will drive consumption, including in our sector.
Puneet, I have a different question. Slightly different with the numbers, Haslinda. Sorry for this, because very keen to know, not just me, but the street would also want to know the update on Sea Rock. But that is going to be really iconic, and we've been waiting for a Sea Rock project for the longest time. Could you update us?
See, we have on the coming Monday, we are doing the Bhumi Pujan, as we call it, on the site. And the last permission left is the commencement certificate, as well as an approval from the Airports Authority for the height of the building. Having said that, we have been on the drawing board for a few years, and this will be the next iconic property, not just for Mumbai, not just for Maharashtra, but for India. Just like Jamshedji Tata built in 1903 the first Taj in South Mumbai at the Gateway of India. This will be the next iconic asset that will come from the house of Tatas to the city of Mumbai, and to be a national pride. And we have done a lot of work, so all the plans will be unveiled Monday. You're most welcome to join at 10 a.m.
So it'll be a game changer.
Every development of this kind is a game changer.
But what will that mean for profitability in the end?
A lot. That asset, any day, any time, once built, is going to drive revenues in 4 digits. That means more than 1,000 crores. No other asset in India does that. The one which comes close to is the Taj Mahal Palace and Tower in Mumbai. This is a larger development than that, so it should do more revenue. And more than that, it is the amount of jobs it will create, is the kind of infrastructure improvement, the ecosystem that it creates. And we have also earmarked a lot of land for public use, jogging tracks, etc. So I think all in all, it will be something good for the community and good for the city.
Any time frame or any investment? Sorry, it's unfair to ask, but we're a bit excited.
Time frame is from the time we can commence. Okay. A development like this, anything less than 3 years to construct is unrealistic. So we are thinking 3.5 years from the day of commencement of construction, which should happen towards the end of this calendar year.
Any investments, sir?
Investment, all in all, including the cost of the land, you're talking about, it's already capitalized, it's open to public because we are a listed company. Already in books at around 1,500 crores. You can add another 1,000 on top, so anything north of 2,500 crores.
But then you've talked about wanting to double your portfolio to 700. Where are you with that?
Well, in the last 7 years, we signed 200 new contracts, opened 100 hotels, despite 1.5 years of COVID. Some call it 2 years. So I think, given that now we have practiced comprehensive brandscape management with a variety of brands that have been added, we are very well positioned to grow, especially on the non-Taj portfolio, which we call new businesses. So we have a Tree of Life, we have Ginger, the reimagined Gateway, and they are really going to drive the growth in numbers, and the profitability of Taj will be the backbone and provide the robust business model so that the new brands can flourish and really be well positioned for the next 50 or 100 years for our company.
You're a global player. Taj, in particular, is a brand name that people know. With the rupee at such low levels, close to record lows, how is that impacting the business?
Well, nothing at the moment that I would say. Actually, it's in many ways a positive thing, because it should attract more foreign tourists to come in. We have fallen short of foreign tourist arrivals compared to pre-COVID levels. So if I was to add a normal, healthy increase like anybody else has had, then we are at less than 10 million, whereas Thailand is at 28, Vietnam is at 13, Singapore is at 20 plus, city of Paris is at 25. So I think there is a long way for us to go. and a weak rupee should help. Having said that, I do believe that the currency at some point will become more and more strong, because you cannot be the number 3 economy of the world and have a weak currency. This is a contradiction. So all strong economies of the world ultimately have a strong currency.
Puneet, always a pleasure to speak with you. Puneet Chhatwal, MD and CEO at Indian Hotels Company, and Bloomberg Conglomerates reporter Pierre Sanjay, of course. Well, those consumption trends here in India mean everyone is keeping a close eye on the future. For the family behind Reliance Industries, that also means a succession plan for the empire. I asked Nita Ambani how she and husband Mukesh are deciding which of the children will take control of different parts of the business.
Well, I didn't decide. They decided. You know, my son Akash has been a tech bluff from the time he's a little child. And I think it just became so much a part of his life to be a part of Jio that led to the largest digital transformation story in India. My Isha is the most intuitive and sensitive girl. It's such a pleasure to, have a daughter who has the same belief system, the same values in life. And to see her as a woman leader today, as a part of Reliance Retail, really brings so much pride in you. And my youngest, Anant, he always was about saving the environment, protecting the wildlife, and now he's leading the green energy project of Reliance. And he runs the rescue and the rehabilitation center for animals in Jamnagar. So all of them are so passionate about what they do. Sometimes just have to watch them fly to their own dreams.
Reliance Foundation founder and chair Nita Ambani speaking to us about Reliance Industries' succession plans. And that's just a taste of our wide-ranging conversation. You can catch it in full on the latest episode of Latitude. It premieres on February 13th on Bloomberg Television and our YouTube channel. Subscribers, of course, can watch on the terminal. Join us tomorrow on Insight for an exclusive interview as well with Godrej Industries Group Chairperson Nadir Godrej. He'll be here in the Mumbai studio ahead of the conglomerate's latest earnings report. But before that, another big interview on Bloomberg Television. U.S. Treasury Secretary Scott Bessent joining us live at the Times on your screen as the Trump administration implements its agendas on tax cuts, spending priorities, and of course, tariffs. That is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.